Hello and welcome to the Monday Technical Market Outlook for September 14th, 2009. This is Patrick Serezna. As always, we start off with a weekly chart of the S&P 500 going back several decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. In January 2008, when we crossed below that 80-week moving average, is about the time when we began our thesis that we were in a bear market that should last many months, if not more than a year in total duration. And right now, we're actually approaching a level where the market may in fact cross that 80-week moving average. Even if we do cross above that temporarily, we are still expecting some sort of a significant market pullback, but that pullback may in fact be just a springboard to actually start that bull market. When we take a closer look at that S&P 500 using that SPDR exchange traded fund symbol SPY, last week we had a robust rally that came off support off that 100 level and now is pushed deep into that 104 to 106 focal point. At this stage, we have now officially entered the zone where I'm looking for that market top. We've been looking for it somewhere in this 105 to 112 area on the upside. And that doesn't mean that we're bearish on the very short term. There's nothing stopping the market from actually progressing higher even for several weeks. But there is a chance that this 105 area where we're at could be the market high, but there's nothing stopping there from being one or two more thrusts higher up into those higher zones. Nonetheless, we are looking for a market top up here. Just to review our key points, our thesis since January 2008 has been that we're in a bear market that should last many months, if not more than a year in total duration. We added to about 6 months ago, suggesting that the bear market could end as early as the fall of 2009, but can realistically extend into the 2010 time frame. Even though we've had quite a significant rally in the last 6 months, more than likely there has to be still one more good push lower to create that basing formation for the bear market for the next leg of the rally to begin, and that's the one we're looking for from that push. On the short term, we don't want to stand in the way of the bulls. There's still the potential for them to make several thrusts higher in this market, but in the bigger picture, we do believe that a short-term top will come in here in this 1,050 to 1,120 area, and we want to be outright defensive as we're getting into the zone right here, as we see little upside for a big downside risk. At this stage, only short-term actively managed trades are prudent. Longer-term investors still need to be cautious and avoid overexposure to the markets. Next here, I want to take a look at the NASDAQ 100 using that exchange-traded fund symbol QQQQ. And we saw that basing last week occur in that 3940 focal point, and it's been used as a springboard to launch that move. We've had that target for the measured move up in the 42.5 to 44.5 area. We're now about $1 away from that. We still think that it's an achievable target on the upside, especially if the S&P keeps going here. Next here, I want to look at that US dollar index, and we had that technical breakdown last week. It really did accelerate on the downside and is finally approaching our downside target down in that 75-76 focal point on that downwards motion. That is where we're looking for our initial move. In a bigger picture, there may be a move all the way down into the 72-73 zone, but if in fact the US dollar in the bigger picture is bottoming, it should not really beat that 75-76 zone on the downside. That would create all sorts of divergences and downside momentum and create a good basing formation from which the US dollar could rally in the bigger picture. But the next few days of selling will definitely give us more information. Next here, I want to take a look at gold bullion using that SPDR Gold Trust symbol GLD, and we've now completed what we called our measured move up into the 90 to 100 zone on the upside. That's accompanying that US dollar index breakdown. If that US dollar index continues to accelerate on the downside here and just actually gains momentum, then the GLD should be able to push up into what's the extended target up into the 103 to 104 zone. But if the US dollar does base in this 75 to 76 zone, then we probably aren't expecting much more upside in gold, and this would probably be a prudent time to take at least some of it off the table. Next here, we're going to take a look at crude oil using the United States Oil Fund, which is the symbol USO. And in spite of the US dollar weakness, which usually creates an upside rally in crude oil, we are seeing a US dollar breakdown without crude oil participating on the upside. It's going to be very interesting to see whether or not this is just the market anticipating a bottom in the US dollar, or whether or not crude oil is actually just lagging a little bit and will still proceed higher. We're going to want to see which way that divergence goes, and whether or not the US dollar bottoms, or whether crude oil still has more on the upside, but we don't expect them to diverge much here. And finally, I want to look at a broader basket of commodities using the PowerShares Commodity ETF, symbol DBC. Now, this particular ETF has a little bit of a larger weighting in the energies, so it is lagging a little bit in spite of the rallies in gold and so on. But we are seeing that broader baskets of commodities are not participating in spite of that US dollar weakness. Again, just confirming what we're seeing in crude oil. And in fact, if the US dollar finds a bottom in that 75-76 zone on that index, then in fact we may be seeing some tops already have been put in place in these commodities. The only thing that we just want to be on alert of is that if the US dollar does actually accelerate, then these may just be lagging before they break higher. But if that US dollar index really stops losing momentum on the downside, that's when we become more bearish on these commodities. That was your Monday Market Outlook. Thank you for joining me.